getting to 50K ETH by 2030, it's about a 50% compound annual growth rate. 5K per ETH, which is roughly the previous cycle's all-time high.
Yep.
That is about a $600 billion market cap, and it's roughly the size of Visa. Okay, in terms of market cap.
Yeah.
So ETH is already doing almost as much transaction volume as Visa. If we reach 10,000 per Ethereum, that's a $1.2 trillion asset, and that would be equivalent to Visa plus MasterCard plus American Express. And let's just throw out the extreme bull case because we have it. You never know. ETH at 50K. All right, wrap your head around that. About roughly 20x return. That would be 6 trillion in market cap. 6 trillion. What's the equivalent asset? Apple plus Google.
Hardly any.
Matthew Sigel starts by discussing the potential impact of Bitcoin ETF on the broader crypto market. He estimates that within 12 months, Bitcoin ETF could account for 20% of the Bitcoin ETF assets under management AUM, which translates to a total asset base of roughly $15 billion. This significant influx could also have a pronounced impact on Ethereum ETH due to its lower liquidity compared to Bitcoin. Each dollar inflow into ETH has a larger price impact, which could lead to a substantial rally in the price of the token. Sigel highlights that Ethereum's current inflation rate is lower than Bitcoin's, and there is even less ETH available on exchanges for purchase. This scarcity could amplify price movements. If Ethereum were to reach its previous all-time high of $5,000 per ETH, it would have a market cap of about $600 billion, equivalent to the size of Visa. At $10,000 per ETH, the market cap would be $1.2 trillion, comparable to Visa, MasterCard, and American Express combined. Sigel even speculates on an extreme bull case where Ethereum could reach $50,000 per ETH, resulting in a $6 trillion market cap, rivaling the likes of Apple and Google. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
So we're saying 20% of the Bitcoin ETF AUM within 12 months. So, that would be a total asset base of roughly 15 billion. And we've seen some evidence that, each dollar of inflow into ETH has a larger price impact because of the lower liquidity for the asset. And in fact, Ethereum's inflation rate is lower than Bitcoin at the moment, and there's even less available on exchange for purchase. So even that kind of 20% estimate could lead to 50% plus rally in the price of the token. And just to kind of give some context around what the rally might look like, if we reach 5K per ETH, which is roughly the previous cycle's all-time high, that is about a $600 billion market cap, and it's roughly the size of Visa. Okay, in terms of market cap. So ETH is already doing almost as much transaction volume as Visa. If we reach 10,000 per Ethereum, that's a $1.2 trillion asset, and that would be equivalent to Visa plus MasterCard plus American Express. And let's just throw out the extreme bull case because we have it. You never know. ETH at 50K. All right, wrap your head around that. About roughly 20x return. That would be 6 trillion in market cap. 6 trillion. What's the equivalent asset? Apple plus Google.
Hardly anything.
Okay, right? So if Ethereum can start to make meaningful inroads into the market share of app stores by taking some users away from Apple and Google, getting to 50K ETH by 2030, it's about a 50% compound annual growth rate, and that would assume that Google and Apple don't grow at all from here.
Yeah,
so
exactly.
We don't think these estimates are like tremendously aggressive. Small Bitcoin correction here. We're off about 20% from the all-time highs in March. But when we look at the past cycles, in the 2021 bull market, Bitcoin had 3 20% drawdowns.
Right.
In 2016-17, there were 7 20% drawdowns. So this correction looks pretty normal in the context of what is a very volatile asset. I think there's some specific reasons why we've sold off, notably the German government selling, Mt. Gox starting to distribute. But as you noted in the intro, a lot of positive things happening on the macro front, elections getting closer, and we feel good about the second half of the year. Well, I think they're in the middle of losing in the court of public opinion, which is causing lawmakers to rethink their votes on this issue, and losing in the courts. And the most, I think, recent notable example of that was Binance winning its case on the sale of secondary BNB tokens, and a federal judge in DC ruled that those sales are not securities. That's exactly what was decided in the XRP case a year ago. So we see, the SEC's legal objection to many of these proof of stake coins like ETH and Sol. Those objections are getting whittled away by the courts, and that's part of what is giving us the confidence to step on the accelerator and put some new filings in the queue. It's become clear that these Ethereum spot ETFs are going to launch with the SEC's blessing. And so that is the SEC explicitly agreeing that they are commodities and letting us file these products under the CFTC's decision on what constitutes a commodity. And since there are futures markets trading on ETH and Bitcoin, becomes clear that these are commodities. I think it's the second order effect. When you get into, so ETH itself is not a commodity, but is staking ETH a commodity? Well, the SEC hasn't agreed on that yet. And what about all the DeFi activity that's happening on top of the Ethereum protocol? Exactly. It's pretty clear over the last couple of years that the CFTC, does not countenance DeFi, and has made, several enforcement actions in the space. If you're going to trade derivatives and, not be licensed by the CFTC, that's going to be a problem. So
for sure.
I think it's it's positive for ETH specifically, the asset, but there are still a whole number of unanswered questions that could get resolved with FIT 21. But from my reading of FIT 21, that it would still be a quite challenging environment for DeFi and DeFi tokens. Long story short, I think you're careful what you wish for with the CFTC is an accurate concern.
Sigel envisions Ethereum as an open-source app store that could significantly impact the market share of major tech companies like Apple and Google. If Ethereum can attract developers and entrepreneurs by offering a better experience and lower costs, it could achieve significant market penetration. He compares the current market value of productive assets globally, which is over $500 trillion, to the gold market at $10 trillion, suggesting that Ethereum's potential market is vast. During the 2021 to 2022 bear market, Ethereum outperformed many mega-cap tech stocks. Despite an 80% peak-to-trough decline, Ethereum's resilience compared favorably to companies like Facebook. Sigel believes that traditional financial market participants will increasingly view Ethereum as a hedge against large tech stocks and allocate portions of their portfolios accordingly.
It's something like a flippening that will tell you when we're at this stage, right? Because when you look at the market value of all the productive assets in the world, it's north of $500 trillion, and the gold market is, call it, 10 trillion. So the overall market for productive assets is 50 times bigger. And if Ethereum can realize its potential as a open source app store that's going to offer entrepreneurs and developers a better experience than building on Apple or Android, and with a lower take rate, then clearly we're not at that point yet. And we're looking forward to educating kind of the traditional finance market participants on how Ethereum might be a hedge on some of their large FANG exposure. By FANG, I mean the big Web 2.0 stocks. And when we analyze the 2021-2022 bear market, Ethereum actually held up quite well versus many of those mega cap tech stocks. The peak to trough decline, about 80%, on par with Facebook stock. Ethereum actually had fewer down months than most of those mega cap equities and tech, and it obviously outperformed on the upside. We think that this open source app store is taking market share and taking margin dollars away from these big tech stocks, and that the traditional allocators will put a little bit in that bucket as they become more aware of the thesis. So that's why we put out that monster report a couple weeks ago with our new ETH price target and doing some quant work around what is the ideal kind of Bitcoin to Ethereum mix in a standard 60-40 portfolio. And we're having a good time presenting those findings to clients ahead of this launch. I mean, when I look at the ETHE right now, it's trading at basically no premium or discount to NAV. So, theoretically, investors who want to get out of that product could do so at any time without a discount. They wouldn't have anything to put it into if they want to keep, the underlying Ethereum exposure. So that's why I think that, the Grayscale kind of spin off 10% into the spot trust is a good move. Well, we're in the business of designing intelligently designed investment products and then letting our clients choose what they want to buy. So we look at these blockchains as winner-take-all assets, that one of them is likely to garner 80% plus market share. If Ethereum can do that, we think it's worth up to 20,000 per coin. If Solana can do that, starting from a much lower base, then the upside is going to be that much larger. So that's basically the bet, is let the client decide. And as it pertains to the regulatory backdrop, this requirement that an asset underlying an ETF has to have a futures market, a regulated futures market of significant size. We think that is a Gensler psyop. The SEC has never had such a strict reading of those rules until he launched. And we can point to several other asset classes like shipping, electricity, uranium, where there have been ETFs in the past, but even if there were a regulated futures market, it wasn't a meaningful contributor to price formation. Even the oil market, look at the difference between Brent, WTI. There's all these different flavors of the oil market. The ETF doesn't require that each one pertain to a specific futures contract. We just think that they're being too strict in the reading of the law, and we look forward to a different administration and different SEC chair being more amenable to that interpretation.
Sigel and his team have conducted extensive research on the ideal Bitcoin to Ethereum mix in a standard 60/40 portfolio, presenting their findings to clients. He mentions that the current trading environment for Ethereum-based products, such as the Grayscale Ethereum Trust ETH, offers no premium or discount to NAV, making it an attractive option for investors. Sigel criticizes the SEC's stringent requirements for ETF approval, particularly the need for a regulated futures market of significant size. He points to other asset classes like shipping, electricity, and uranium, where ETF exist without such strict regulations. He is hopeful that future regulatory changes and a more accommodating SEC administration will ease these restrictions. Please like and subscribe my channel.